Get ready to get your questions answered by financial advisors. Learn how to put more money back in your pockets regardless of where you're starting your financial journey. With your host, Hannah Mitria. I'm excited to have you on, Peter Lazaroff. You're the author of Making Money Simple. You're the host of the Long-Term Investor podcast and a certified financial planner. So welcome to the show and share with us about your business and then kind of how you got started.
Well, Hannah, thanks for having me. So how I got started, if I go back to the beginning of my career, was in 2007, graduated from school in May 2007, and went to work for an independent RIA as an investment analyst, right at the peak of the stock market and before we had about an 18-month downturn that we all remember as the great financial crisis. So that was pretty formative in a lot of how I view things and how I view risk, but it also was a really great opportunity to experience a downturn. So for me, I was 22 years old and I thought, well, gosh, this is just normal. Whereas in fact, it was anything but, aside from the Great Depression, one of the most severe downturns. But I think that's really colored my view on what a bear market should feel like and how you should behave in that. And maybe that's something we can get into. But I went from being an investment analyst. I got my CFA charter. CFA stands for Chartered Financial Analyst. And after that, shortly after that, got my certified financial planner or CFP designation and started working with clients, but still had a really heavy focus on the investment side. So at the time that I moved to Plancorp, I went there as the director of investment research. And today I'm the chief investment officer. So me and my team oversee roughly $6 billion for clients all across the country. And, on top of just setting that policy at the firm level and doing a lot of communication of that policy internally, externally. I also, as you mentioned, have a podcast called The Long-Term Investor. I write for the Wall Street Journal and Forbes, and I have a book called Making Money Simple. So fortunately, I have been able to lean into one of the things that I love most, which is learning. And for me, learning is all about something that my parents, who were both in the medical profession, had talked about in medical school. You learn through the process of see one, do one, teach one. Mm-hmm. And my blog posts, my podcasts, my videos, those are my teach one as I go on learning. And every time I learn something, I realize how much more there is to learn. So really pleased that my career arc has gone on this path and really enjoy the team that I work with at Plancorp.
Awesome. And that's exactly what this podcast is really to help teach other people about financial advising and, understand the steps. But I think it's so neat that you got started right in, a bear market. You got started in the middle of a downturn. So it kind of brings a question of right now, I think people are freaking out that we're going into that same situation again. So what differences are you seeing from, in 2007, 2008 versus now? Do you kind of see it going in that same direction, or is this just a little slope that we're going into and then we'll move back up?
Yeah, well, as of this recording, we're in a bear market now. Mm-hmm. So just to level set, a bear market is when we're going to use the S&P 500, which represents about 80% of U.S. companies, mm-hmm. when that is 20% down from its high. So we're in the midst of a bear market. To me, there's a number of big differences. I mean, this all feels relatively orderly for market losses. The financial crisis, there was a real concern of whether the system as a whole would survive. Financial crises tend to be more severe just in nature. And so this is really more of a pandemic economy that nobody really understands. So we had a massive boom after the 2020 contraction. We're starting to see some of the spillover effects of that. And so as interest rates are rising, people are expecting that unemployment will start to creep up. And I think you're seeing that reflected in stock prices. So one of the things about bear markets, though, and stocks in general, is that it's when they're going down that they feel risky. And it's not to say that stocks aren't risky, but it is that uncertainty and it is those temporary losses that you sort of have to experience in exchange for a higher expected return. So a lot of times as I'm speaking to clients, I talk about these periods even before we're in them. Basically any meeting, anytime I get the opportunity, I remind them that, hey, the market goes down 10% on average every 12 months and 20% or more on average about every 3 years and 30% or more about once a decade. And it doesn't happen on a calendar schedule, but it does happen frequently. And so we are going to plan on it happening. We're never going to predict when or why or how, but we are going to plan on these downturns happening with a similar magnitude and frequency as they have in the past. And anytime you're planning rather than predicting, that's usually going to lead to a better outcome. And so when most people say, hey, is this a really risky market to be investing in? Well, if prices are lower, that means expected returns are higher. And my perception is not one of, hey, this is really dangerous. This is dangerous to my health or well-being. My perception is, no, this is more annoying. I don't want to live through a bear market. Nobody wants to live through a bear market, but it's sort of a necessary evil if you're going to be a long-term investor.
Yeah, that's an interesting way to look at it. I've never really heard it that way, where it's happening this frequently. So we should plan
totally normal. And I think once you realize how normal it is, you can shift your mindset. And I think that's really important to have the historical context of market returns. I think the more that you understand financial theory and portfolio theory and asset pricing theory, which again, you don't have to know the great details of it, but when you're really understanding how markets work, what's happening right now is normal. And again, I would say orderly. Compare that to 2020, where people were concerned for their health and the entire global economy was literally turned off. That was very scary. Here, what we have happening almost feels like a textbook type recession, in the sense that, hey, the economy is arguably overheating. There's a little bit of inflation, not a little bit. There's a lot of inflation. The Federal Reserve is responding to that inflation by saying, hey, we're willing to push unemployment levels up, which is kind of verbiage for we're willing to experience a recession in order to make sure that inflation doesn't stay elevated. And so when interest rates go up, economic activity tends to contract. You have a recession. The two recessions in the US that we've had in my career, the first being the financial crisis, the second being COVID, this is far preferable to me than those. There seems to be far less uncertainty. And there's still no guarantee technically that we will enter a recession. I'm personally of the opinion we are, but I don't change the way I invest as a result of that opinion. And I think that's really an important distinction as well, because again, not predicting when or why downturns or recessions are going to happen. I'm just planning on them happening. And that's all part of a financial plan. And as long as I continue to follow my financial plan, then I should be okay.
No, I think that's a really smart way to look at it. And when you have that mindset shift, you're able to prepare for it, because, in 2020, when COVID hit, that was a crazy time for financial. I personally, that was the first time we actually entered stocks because they were so low. It just, for us, we're like, grab them and hold. What's the worst that can happen? No one will have stocks in 5 years, or they're going to go up. There was one of two choices. And so we took the choice. But that kind of leads us into the question of, when is it the right time to get into a down market? Is there a right time? What is your thoughts there?
Well, so you can never know when you're going to be at a bottom. If you have a long horizon, and let's call a horizon 10 or 20 years, there's really, especially when you get to 20, 30 year time horizon, there is not a bad entry point. You could only invest at the market peaks. Imagine the only time that you invested money was at the market peaks. And as long as you don't sell, you're ultimately going to have a decent return. Returns are higher when markets are lower, but over a multi-decade time horizon, there is no right or wrong time. I will say that it's all a matter of trade-offs. So I wouldn't invest money that you, at any point in time, that you might need in the next, say, 5 years. But again, if it's long-term capital, if you're maybe going to try to live a bit more frugally and make some extra investments, what's the right point to do that at? And again, there's no knowing, but if you're going to measure the trade-off between the market potentially going lower, as well as potentially not investing by the time it starts to recover, I've always felt like 30% is a nice entry point. Again, market doesn't always reach. So you could be sitting around today saying, okay, I'm going to wait until the market drops 30%, and then it never gets there. Similarly, on the other side of that, you could have the market go down 30%, invest your money, and then the market goes down again so that it's ultimately down, say, 60%. And during the financial crisis, it almost went down 60%, the S&P 500. So there's really no way to say when's the right time. But I would say that if it's part of a regular savings plan, whether it's to a retirement account like a 401k, 403b, or Roth IRAs, IRAs, and you're just dollar cost averaging, well, just don't stop that dollar cost averaging. Just keep buying. if you have some sort of a windfall, the math would suggest that you're better just investing it all at once right away than dripping it in over time, and certainly trying to wait for the right moment. So, you have an inheritance, or you have stock options vest, or if you win the lottery, yay, you should just dump it all in the market right now. If you're trying to, again, pinch pennies to find the right time to take some extra cash that you've either created somehow through a side hustle or sold something, or like I said, live a little bit more within your means, there is no right answer. To me, I've always gotten excited when the market's down 30%. In fact, we always send out a market newsletter when the market's down 10%, because that's the point in time when people call it a stock market correction. There's no formal definition of what correction means, but most people agree that like when the market's 10% off its high, we're in correction territory. And then the bear market's 20%. And whenever I send out this newsletter to clients, family, friends, prospective clients, I'm always like, gosh, 10%. This is so normal. Like, wake me up when we're down 30. And that's always been something I've said since kind of looking at the numbers a long time ago. There's no right or wrong. It's just a personal preference. But I have not altered any of my investing behavior to this point. Just continue to make my regular contributions to retirement accounts. Again, if I had found money, maybe I'd wait till we're down 30. But I also, if it was money that really didn't have a purpose and was designed to be invested for 10 to 20 years, now is as good of a time as any. You're not going to be upset about it 10 years from now, having invested today.
Yeah. And I think you made like a crucial point early on too, talking about how, the money you're investing needs to be money that you don't need in the next 30 days, 60 days, even the next year. And that money, then you're not sad if you have to hold on it or sit on it and wait on it. And I think that's really important. And then, so let's say the market goes down 30%. Is there a better investment? Like, is there a certain way we should be looking? Should we be looking at stocks? Should we be looking at bonds? Like, where should we be looking to invest that money? Do you have a recommendation of what type of investment is better in a bear market?
Well, it's an interesting question. I guess what type of investment is better all depends on your horizon and what you're looking to try to get out of it. But I can make a few broad statements, is that I don't think buying individual stocks or individual bonds is a recipe for success. The odds are stacked against you that you'll do well. So you want to be diversified. Whether you should buy a mix of stocks and bonds that is much heavier stocks. So let's say, should you put your money in all stocks versus 80% stocks, 20% bonds, or 60% stocks, 40% bonds? Should you leave some in cash? I would say that it is person to person specific. It's kind of based on your willingness and ability to tolerate risk. But the one commonality I would say is that you want to be globally diversified, both on your stock and your bond portfolio. You want to keep costs as low as possible, because there is a very, very meaningful correlation between costs and future performance. And you will see all over investment materials, past performance does not guarantee future results or something like that. The thing, though, that we know from empirical research is that low costs, on average, do tend to provide better returns when you're just ranking the entire universe. So I would say that's a good approach. And I often, if I don't know anybody, I point them to index funds. I'm not saying that index funds are necessarily the absolute answer and best option for everyone. But when I don't know anything about the person who's receiving the advice I'm giving, it's a really safe thing for me to say. It's also why you see people like a Warren Buffett recommend them, or, there are people out there who know that their words carry weight. And so they want to minimize regret and minimize damage. And personally, if index funds aren't the best option, I'm not saying they aren't, but they're at a minimum 1A, they are right there. So it's hard to go wrong there. If it's in a retirement account, maybe you're using a target date fund that only uses indexes based on when your retirement date is. If you're investing taxable dollars, perhaps you take a different approach. But I would say that this is one of the values of having a financial advisor, is they can earn a lifetime worth of fees in a bear market by making sure you avoid mistakes, as well as optimizing your investments for the long run.
Awesome. And I'm glad you jumped there to mistakes, because my next question was going to be for you is, what are some like red flags when you're investing in a bear market? What are some things that you'd like absolutely walk away from in those times?
Yeah. So one thing I referenced earlier was you shouldn't buy individual stocks. And I think that applies to like thematic ETFs. So let's say you hear through some sort of quote unquote financial expert that you should buy this biotech fund or some technology fund or innovation fund. Any fund that has a theme is really not in the business of outperforming the market. They're in the business of asset gathering because it doesn't take a rocket scientist to figure out that managing a $1 billion fund makes you more money than managing a $10 billion fund. And so thematic investments tend to play on investor psychology and investor enthusiasm for certain parts of the market. Really what you're trying to do when you make a bet on an individual company or a sector ETF or a thematic ETF is you're trying to outsmart everybody. And I assure you that if there were a way to systematically outsmart people in such a manner, a Nobel Prize would be already given out for it. And the thing is that there are Nobel Prizes that have been awarded in the last 10 years that basically cements the exact opposite, that you can't systematically outsmart the market. So what I would, again, things to avoid would probably be what I would call security selection. So buying individual companies, buying thematic ETFs, sector ETFs, country ETFs, so single countries. The other thing I would try to avoid are options. So I see a lot of people use options trading as a way to create some leverage in their portfolio and get cheap access. But unless you really understand how options work, yes, they can work for you for long periods of time. But then the one time they don't, they can just completely put you in the red. You can lose everything quickly if you don't know what you're doing. That's a hard lesson that a lot of people learn. And they'll maybe even have success for 5-10 years doing option strategies, not really understanding the underlying risk. And all it takes is one period to blow up the whole portfolio in that sense.
Yeah, no, those are some really good things to look at, especially, the whole themes and, we hear them, especially in the tech industry and different things like that, of, all of these things. And so, if you're in the tech field, you're more leaning towards those to want to go after them. Or even I hear a lot about like investing, things like that, but it's kind of neat to hear, like, even just go back to basic, like you said, the index fund, start there, look at, what has performed year over year. Like I remember being in college, and I think it was GM has been on the index for like a century almost. So we know that they're working and that they keep going. So I think that's great advice there. And then how can you tell if we're going into a bull market or a bear market, other than, we've just dropped 20%, because what are the signs that you're like headed that direction and it's not just going to pull back?
Yeah, unfortunately, there's not a good answer for that. And I think that if you are trying to predict where the market's going to go, the reason that that's so difficult is what you're really trying to assess is where the market, which is made up of millions of participants, where their collective psychology is going. What is the mood, the aggregate mood of millions of different people across the world? And I think it's really easy to feel like, oh yeah, I have a pulse on what people are feeling like because you read the news and you listen to podcasts and you're on social media, but you don't, again, you have to really think about who is driving prices. This is millions of people across the globe trading $500 billion a day. Understanding not just what events are going to happen, but how collectively those investors are going to feel about those moves is really, it's basically impossible. It's a really daunting task. It's something that the more you learn about markets, the more you respect the level of competition that is there. And I am all for people trying to compete against the market, whether they know about they're doing that or not. I think you end up learning a lot about investing that way. Sometimes I would say if you're going to be active in your portfolio and make predictions and try to trade based on where you think things are headed, to limit it to 5% of your portfolio. And when I say 5%, I mean, look at the number you have today, carve out 5%, and like whatever it is, that's it. You don't get to keep funding it up to 5% of your portfolio. Because over time, over the course of an investing lifetime, there's no way that you're going to beat the market. You're just not. And I've seen enough people doing it. Having done it myself, I had a nice run. I feel like I saw the light at a really opportune time to realize that all the success I was having was primarily randomness and luck. And so it is a very humbling lesson to learn, but I don't discourage people from learning it. I just ask that they control the amount of money they're learning with.
I'm glad that you just said that, it's not predictable, because I think we all are looking for that quick and easy answer, and it's just not there. Like you said, the market's super competitive, and it's its own machine at this point where it's doing everything it needs to do in the order it's going to do. And we can't predict emotions, and that's what the market is. All of us working collectively in our own world to make stuff happen. So what other advice would you want to give about, investing during a recession and like putting yourself in the best situation?
I think the best investment you can make beyond putting money in the market is investing in yourself. So money is a really important topic. You could choose to invest in a financial advisor, not a cheap investment, by the way, but one, I realize I'm biased, but one that I think can pay massive dividends over your lifetime. So that's one investment you might consider making in a recession, is getting someone who full-time is concerned with taking care of your money needs, someone who's going to advocate for you, someone who's going to put their fiduciary commitment in writing and act as a fiduciary at all times. I also think that you might consider learning more. So if you're investing and you have never read a book on investing, that might be a good start. I think in general, you can get decades, if not centuries worth of information from reading just a couple books. It doesn't take much. In fact, I actually have a list of books that Hannah, I can send your way to put in the show notes if that's helpful. Just categorized by like beginner, intermediate, advanced, other. And I think that's, an investment in yourself, either through hiring an advisor or taking the time to read and learn. I think that's probably the best investments other than buying stocks at low prices in a bear market.
Yeah. Awesome. No, definitely send that book list over. I'm an avid reader, so I definitely will check it out, see what things are on there as well. And then also, I know at the beginning you mentioned or shared a little bit about how you're in the Plancorp and that it's a chartered financial analyst, correct?
Yes, I will say a CFA charter holder because I passed my ethics part of the exam.
All right, awesome. So tell people how they can get in touch with you, how they can work with you, your specialties that you work through.
Sure. Well, so at Plancorp, we have a team approach where no advisor has a book of business. You become a client of the firm. And what's great about that is you get access to everyone. So as chief investment officer, I don't lead the day-to-day relationship with anyone. However, I regularly and seemingly constantly am in client meetings and working with clients. So people who come to Plancorp through my website, peterlazaroff.com, typically we'll work together a little, but candidly, you want one of our wealth managers leading the relationship. You don't want me leading the relationship. I know enough to be dangerous about planning items. I have my CFP. I do this stuff all the time. I write about it, but realistically, you want one of our real wealth managers to handle your day-to-day stuff. But you'd mentioned, where can they find me? They can go to peterlazaroff.com. They can go to thelongterminvestor.com. I also shared a couple links. If you want to sign up for the newsletter, it's just peterlazaroff.com/newsletter. You can get a free chapter of my book. If you rate and review my podcast and send me an email, I'll send you a whole copy of the book. So, any of the listeners out there who want to do that, all you got to do is send me a screenshot of your review of the Long-Term Investor podcast. And I'm happy to sign a book and send it your way.
All right, awesome. And I'll put all those links in the show notes for everybody to see. Definitely, if you want to get on his newsletter, so you get it when they are at a 10% loss in the market, so you can go invest, join his newsletter. And then also put the Long-Term Investor, so you can check out his podcast as well. And then definitely go rate and review so you can get that free book. But Peter, thank you so much for joining us today. And I look forward to having this out for everybody to hear.
Thanks, Hannah. Take care.
Thank you for joining us this week on the Virtual U.S. Financial Advisor podcast. Subscribe to the show on Apple Podcasts, Spotify, Stitcher, or via RSS so you'll never miss an episode. We'd love a rating on iTunes, or better yet, tell a friend about the show, which will help us grow as well. If you want to learn from any of our financial advisors, head over to our website, virtualusfinancialadvisor.com, to learn more about each financial advisor and connect with them personally. Be sure to tune in next week to get more advice from the expert financial advisors. See you on the next episode.